Even while retirement may seem distant, if you're in your 20s or 30s and want to live well, you may not have many options. Yet, investing early is one of the finest ways to live comfortably. It goes without saying that you must acquire a substantial quantity of money, and one of the most effective methods to accomplish so, particularly for the working class, is to invest your money. You will be substantially wealthier. So, if you begin investing early, you will have a greater chance of achieving financial success. Here is a marvelous. Suppose you begin investing $500 each month and obtain a return of 8% when you retire. You will have $2.16 million if you begin saving at age 25 and continue until age 60. Nevertheless, if you began investing at age 40 instead of 25, you would have only $341,000 to your name. This simple example, which assumes an investment with an annual compounding rate of 8% without taking inflation into account, is of course not novel. I've already stated that this is not novel, so you've likely already heard it. But for the vast majority of individuals, this is still the best strategy for increasing wealth and ensuring that you have a significant reserve to use in times of need. In other words, starting early positions you for success. Today's video will focus on some of the most crucial assets and investments you can make while you are still young. Let's start immediately on the screen. The investments I will discuss in this video are presented in no particular order of importance. So let's begin with the initial option. Before turning 40, index fund stocks are among the best investments you can make. They may be extremely dangerous, yet offer some of the greatest possibilities. You will have plenty opportunities to make errors and learn from them as you embark on your financial journey, but you should always make well-informed decisions. The average return on equity relative to the benchmark S&P 500 index is 10%. In truth, few investments provide a rate of return. Its high bond content may be an asset. While developing a strategy for an index fund, bonds are the safest investment with the lowest return. If your portfolio's bonds are weighted between 10 and 20%, your investment is safer. Thus, you may also provide the percentage and adjust it according to your risk tolerance. Very recently, index funds for cryptocurrency were introduced. Even though they have not yet passed rigorous testing, they appear to be quite promising. Current return rates are exceptionally high, ranging from 10 to 15%. However, the risks increase in tandem with the rate of return. The fact that index funds have lower costs is a significant advantage. In excess of diversification, the returns improve as the fees fall. Several index funds also offer the benefit of low expense ratios. Costs associated with investments should be minimized as much as possible because they will quickly reduce returns. As you purchase an index, you should be mindful of the tax implications. To real estate. Real estate is one investment where you nearly never go wrong. Real estate is one of the best investments for a multitude of reasons. Secondly, there is typically a housing scarcity, and the value of real estate assets increases almost constantly. Homeownership is the initial step in real estate. When you invest in a home, your costs, such as rent, decrease. After purchasing a home, you may consider developing more business properties. They may include multifamily homes, townhomes, commercial properties, and other types of real estate. If you are unable to directly participate in the real estate market, you still have other possibilities. You can invest with as little as $500 on a number of crowdsourcing websites. The monies would subsequently be utilized to acquire real estate assets and solicit donations from new investors. These investments are known as real estate investment trusts, or REITs. The third is education. According to statistics, the optimal age to begin a study is in one's 20s. Researchers discovered that the ideal period to acquire new skills is between the ages of 20 and 30. Hence, the time may be right to complete that additional degree. Education can contribute to your professional success, but you must recognize that not all education and information are advantageous. Due to the fact that certain research can be considered a hobby, it is unlikely that you would be able to earn money from it. If you intend to invest in education, you should first select jobs that you are familiar with and that have the potential for success. Also, the timing may be right to improve your financial knowledge. 4. A company startup. Make an early financial investment in a startup business. Why the advantages of business ownership are: with a limitless return on investment, you can earn as much as you desire. Even if it is not the next Amazon, another investment you should make in your 20s is a startup company. There is tremendous potential for ROI explosion. Youth investors can enjoy tremendous returns on their investments. You are not required to start the company from beginning in exchange for stock. You can make investments in the businesses of others. For example, if you know the entrepreneur, angel investing is an excellent choice. Your investment may be in the form of a convertible note, which means that if a certain condition is met, it can be converted into cash. The replacement is through crowdfunding. Numerous crowdfunding portals promote tremendously promising businesses. Before investing in a company, conduct extensive study on its founder and familiarize yourself with its history. Choose businesses with intriguing pasts and proprietors with business-related knowledge, expertise, or a degree. Partnering with a venture capital fund allows you to transition from accredited investor to venture capitalist. However, these funds are subject to tight regulations and a minimum investment threshold. 5. Treasury banknotes, regardless of age. Treasury must be purchased by investors. There is no better time than youth to consistently purchase treasury bills. Treasury bills are short-term government-guaranteed debt instruments intended to support spending and control the money supply. There are 3 different maturities for treasury bills: 90 days, 182 days, and 364 days. Everyone has expenses, such as tuition, rent, or even professional examinations. Cash on hand may be invested in treasury bills and withdrawn when the bills mature. This is an example of the financial principle known as asset and liability matching, which comprises the purchase of an asset to generate funds to settle an upcoming liability. Treasury bills are risk-free. Thus, unlike other investment options, earnings are certain. Why wouldn't you invest in them if they offer acceptable returns? 6. Dividend-paying and growth equities. We have made it quite obvious that you should take risks between the ages of 20 and 30, since you still have time to recover from any losses. So, purchasing stocks is a terrific way to invest in a high-risk, high-reward organization. Growth stocks are simply securities with predicted yearly growth rates that are significantly higher than the industry average compared to their competitors. These stocks generate more consistent cash flows and revenue. In contrast, dividend stocks are often issued by mature, financially healthy companies. Thus, their stock values are less volatile than those of growth stocks. You should immediately begin adding dividend-paying equities to your portfolio. If the companies maintain their current levels of performance, they will have the opportunity to create a consistent income over an extended period. 7. Stock exchange. Let's analyze ETFs, which are similar to the index funds we previously examined. ETFs are similar to index funds due to the fact that they are composed of a variety of securities, such as stocks, bonds, and gold. Since they are traded similarly to stocks, shareholders can buy and sell shares on the market. Because to their versatility, they are valuable investment vehicles, whether in huge market indices such as the S&P 500 in fields such as technology or health, or in specialist markets such as social media or robotics. 8 commodities are represented by EFTs. In economics, a commodity is an economic good, often a resource with complete or significant network effect. In other words, the market considers all examples of a product to be identical or nearly identical, regardless of who produced them. There are a variety of ways to invest in this. The initial step is to invest in various quantities of actual raw resources, such as precious metals. Also available to investors are exchange-traded products, or ETPs, that closely track a certain commodity index or futures. Typically, only seasoned investors are urged to engage in these challenging and extremely volatile deals. Mutual funds that invest in companies with a concentration on commodities are an additional approach to gain market exposure. For instance, an oil and gas fund may own stock issued by companies engaged in energy exploration, refining, distribution, and storage. Investing in commodities has advantages such as portfolio diversity, potential rewards, and inflation. Commodities have also done the best during periods of inflation, making them one of the top 9 annuity assets to own. An annuity is a contract between an insurance company and you in which the insurance company commits to pay you on a recurring basis, either immediately or in the future. An annuity can be acquired with either a single payment or a series of premium payments. Many annuity contracts offer savings options for retirement. Others could use your investments to produce a source of retirement income. Some individuals continue to combine the two. If you utilize an annuity as a savings vehicle and the insurance company delays your payout, you have a deferred annuity. In contrast, you have an immediate annuity. If you utilize the annuity to establish a source of retirement income and payments begin immediately, the annuity is suitable. A substantial commission on an annuity may be 7% or more. The following are 10 cryptocurrencies and initial coin offerings. Conventional Wall Street investors have just recently shown interest in cryptocurrencies and initial coin offerings, ICOs. Still, the ICO raised an astounding amount of funds. With more than 1,000 various cryptocurrencies currently in circulation, it is crucial for investors to understand the complexities of the investments, products, and risk levels. Yet, we do know that their returns are very high. The potential returns range from 12% to 200%. ICOs have sometimes performed exceptionally well. For instance, the OTA received a return on investment of 13,000 times. In other words, you would have earned $13,000 if you had invested $1 when it was delivered. This concludes our video for the day. If you are still here, you must have loved the video. Thus, please give us a thumbs up, subscribe our channel Luxe Mindset, and click the bell icon.